Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody. Back another episode of the Apartment Gurus coming at you. And I really love episodes like the one that we're about to do and record because I like having guests on that maybe so many of the guests on this show have just, written books and crushed it in their space and own thousands and thousands of units. Maybe they've disposed of thousands of units. We have other industry experts on too, but I really like catching people sometimes in the early stages of their growth pattern, their growth, their trajectory into their business. And today we have Karl Krauskopf. I got it right, didn't I, Karl?
You did.
Oh man, that's great. We have Karl with us today, and Karl is he's under contract on a 30-unit building. He has a few dozen multifamily units right now, and is working on other deals and has big goals in the space. Like I just was looking at your goals. Let me find them again. It's you want to own and operate a multi-billion-dollar assets under management firm with a separately valued property management, brokerage, and construction company. Yep. So you want to be vertical, and you want to own multiple billions of dollars worth of real estate. I think not only do I think that's an amazing goal, but I think you can do it, Karl. I really do.
Yep. Absolutely. Yeah. Yep. I think growth and super, super intense, laser focused, if you will, on growth and building the right infrastructure. Really up front is, both myself and my partner, Chris Bowen's real insight, real goal. And again, staying laser focused on where we want to be and knowing exactly, or maybe not necessarily knowing exactly all the pieces that go in, but, right. Just being aware that sometimes we don't know what we don't know, but planning as much of it as possible and making sure that we take massive action, and we do it now. Yeah.
I've heard it said that you need to be prepared to take action with about 70% of the information required to make the decision in this space. And that makes sense to me. There's numerous times that we've gone under contract on a property and we've not been 100% sure about, say, what the interest rate on the loan was going to be, right, or how much money we would have to raise, or those sorts of items, and you just need to. And sometimes, like, it's bigger than that. Sometimes it's like, I'm not sure where we're going to get the equity, kind of thing.
Sure.
And to get big things done in this business, there are times when you need to make those calls, and obviously, you want to minimize your risk and you want to maximize your level of knowledge and data on these projects. But that's what due diligence is for, right?
Right. I think that's one of the strongest characteristics, or certainly one of the top 10 characteristics of an entrepreneur, is the ability to act with action, with limited data, available data. if you will, and really be able to follow through, execute on the plan, and I mean, ultimately changing the plan and executing on any kind of change plan. So,
yep, absolutely, well said. So, Karl, if you would just kind of take us back, in your take us down memory lane, if you will,
Sure.
As far as some key points in your story, both personally and professionally. And then specifically tell us about your real estate story, and then we'll talk about kind of where you are now and where you're headed.
Sure. So I'll work backwards prior to the where we're heading right now. Is I've been in this business full time now for about 18 months, and we've got just shy of, I would say, about $10 million assets under management. So about 18 months, primarily been focused on the townhome construction, detached ADU or mother-in-law cottages, if you will, construction there. And even before I mentioned that is, we're right now we live and we do all of our business in Seattle, Washington. So place where land is constricted, land availability is constricted. And as I'm sure everywhere else is experiencing is compression, or rather constriction on pricing. So so certainly wanted to mention that from a location perspective, and kind of why and where it's guided all of our purchasing decisions and where we want to be going from an asset perspective. But so 18 months in the business full time, spent about 12 months prior to that, maybe 18 months prior to that, building a real estate business on the side. So really it was focusing on mornings and focusing in the mornings and evenings on flipping homes, and on the weekends as well, flipping homes, really understanding the construction and management process from a subcontractor perspective, and honing my skill, honing my ability in there while also working a full-time day job. Spent about 10 years in a corporate director, corporate strategy and business development position, all focused in healthcare business services specifically.
Okay.
And honestly had zero real estate experience. I bought a home once. That's all I had prior to this. About 4 to 4 years at this point ago.
What was the inspiration to how did you catch the real estate vision?
So the real estate vision was caught based on, of all things, had this foreshadowing or this vision, I should say, where my wife worked in education. I was in a corporate position. My wife said salary, you could look 10 years into the future and understand clearly what she was going to be making. I knew that my salary was solely based on work I put in. It was not a commission-based role, so it was. You work 18 months, and then you may or may not get a bonus. You may or may not get a promotion, and this huge delayed gratification, and it just wasn't aligning with where we wanted to be as a soon to be new family. I mention all this because we were also in the middle of trying to have our first kid, and I started the side business when my daughter was 2 months old. So, it was really this impending expense and restricted income kind of put me into this corner of, hey, we need to go out and understand and figure out how do we make more income. Because I feel like at that point we had dropped as much expense as possible. So, friend turned me on to real estate, owning small multifamilies. Did about 6 months worth of self-education and reading every single book, listening to podcasts, etc., and just absorbing as much information as possible.
What books were key for you in your progression?
Sure. So there were, I would say out of the two would be Rich Dad came later. Rich Dad, Poor Dad came later in my kind of self-discovery, self-education standpoint. The Richest Man in Babylon was probably the most foundational, just understanding that money can make money itself and always wanting to put money to work. And that was a big question for me. I didn't know, and I didn't realize that, we could be doing that. Obviously, as a corporate employee, we had access to 401ks and IRA distributions, or not distributions, but contributions. And, that was all well and good, but I never had access and wouldn't have access to that for another 20 to 30 plus years. And so there had to have been another opportunity.
Yeah. All right. So Richest Man in Babylon, any real estate specific books or multifamily specific books that?
Yeah. I mean, certainly came as the journey progressed and as I, started unfolding the niches. So Jay Scott's Ultimate Flippers book, and I'm sorry, I don't remember the exact names, but Ultimate Guide to Flipping was certainly on the front end of the list as I was understanding and exploring ways to get some big capital bumps on the front end of the journey. Then, recently, I would say as of about a little more than a year ago, kind of Q4 of 2021 would have been where we started seeing the writing on the walls of, hey, we need to start getting into the multifamily large apartment complex holding position. As we started, most of all of our business, I should say, was in the residential space, townhomes, single family home flips, et cetera. And that started another 3-month self-education phase, if you will. And that was one of the bigger pockets, investing in small multis, investing in large multis, apartment complexes, et cetera, were two of the big ones that, rather the latter was the big one that really helped kind of spur me and get me into a position where, we were hyper focused in getting into the apartment space.
Which book was that?
It was Brian from I think it was Open Door Capital.
Okay.
I forget the last name. But anyway, investing in apartment complexes, one of the bigger pockets published books.
Got it. Yeah.
Yep.
Okay. Great.
Yeah. So that was certainly one of the basic ones that, again, really spurred that self-education journey a little more than a year, or less than a year ago, I should say.
Yeah. And then what about podcasts? Any stick out to you that really were informative?
So there was one that I really enjoyed. Obviously, this delicious one. Love absorbing what you and your guests have to say. I think it's been a tremendous value for me, and I'm sure as many of if any of the other guests that you've hosted here as well, or excuse me, that have listened here as well.
Oh, I appreciate that.
One of the other ones is I think it's Takeout Multifamily. I don't remember the exact name, just because it's again focused on just one or two podcasts. But other than that, nothing specific to real estate. Everything else is economics focused, global news, and how the macroeconomics impact real estate, commercial real estate specifically.
Yeah. Okay. Awesome. Any thoughts on? I want to talk to you about the 30 unit, but any thoughts on market strategy in terms of other markets other than Seattle? Are you guys just kind of set and good to go in Seattle right now?
No, so that's a good question. Right now the approach, or rather the last 3 months, the approach has been, we've been getting some pretty solid opportunities here, and I'll call it the Puget Sound and Washington market in general. Mm-hmm. We've been getting some solid, I would call them single hitters. These 30 units, for us at least at this point, are solid single hitters where we're able to go in, really truly understand how to operationalize either a legacy property management company or a new property management company.
Oh, okay.
And truly stabilize and get to a solid pro forma number. Yep. And then take that recipe and move it to another market. So, we certainly want to be outside of just the Washington state. I would say specific markets would be, Southeast, whether it's, some of the secondary markets outside of Atlanta, secondary markets outside of Raleigh, and a few of the secondary markets in Florida, Jacksonville, West Palm, and some of the secondaries outside of Tampa as well, are really, say it again.
Great markets. Yeah. All of those. Yeah. All of the above.
Yeah, absolutely. So really it's this kind of coastal concept, obviously Atlanta and Raleigh being two of the exceptions. But yeah, really taking a recipe that, we'll be able to get with these upcoming apartments, these upcoming acquisitions that we've got, and really expounding them over outside markets. And, ideally, we are able to operationalize without the requirement of other co-GPs, but certainly open to that concept as we start to unravel the actual assets in those markets.
Yeah, gotcha. Awesome stuff. So talk about the 30 unit. Talk about this deal that you're working on.
Sure,
that you're getting done. Yeah.
Sure. So this is a really exciting one. There's a couple of reasons I really love it. So it's 3 tax parcel IDs. It's this gorgeous property in a city called Wenatchee, Central Washington.
Love that place. Yeah.
One of the bigger, I think it's the biggest Central Washington city and one of the bigger ones in the state of Washington. And it is the apple capital of the world. So it's a really agricultural based community, which in my opinion is well positioned going into a recessionary time. So we're still going to need farmers. We're still going to need farming. And the majority of the folks that are renting from A, that are living in Wenatchee, and also B, that are renting from this particular asset are agricultural based employees.
Gotcha.
So we look at our demographics, our renter demographics, and we say that we're solid from a recessionary standpoint. So we're excited about that. I think the exit strategy I'm even more excited about. So initially we went into it looking at it as an entire 30 unit project. We were going to go in, stabilize it, hold it, and then sell it as a 30 unit project at the end of the hold period, which we ranged from originally 5 to 7 years, but we landed with a 10-year kind of worst case scenario situation. But we three tax parcel IDs. One of them was a vacant parking lot, and our initial idea was, let's go in, let's permit it over the next 3 years, permit it and maybe build on it, or maybe just sell it to a developer. And now we're looking at it quite a bit differently. So as soon as we go live, we're looking at as soon as we go live with this listing, or rather go live with the acquisition, is bring to market that vacant lot and just sell it off immediately. Not even put the time and effort and resources into developing it or doing anything with it, getting some value and just liquidating it immediately. And then that would leave us the 2 tax parcel IDs, which is comprised of a 24 unit Bavarian style architecture. This thing is drop dead gorgeous. Absolutely. The market, the city itself, if you talk to anybody on the streets that have lived in Wenatchee, they know these apartments because of their historical meaning and historical position within the city. Super cool.
Nice.
Included in the sale is also another parcel ID next door, which is a 6 unit cottage. So it's 4 individual detached homes and a duplex. And again, going into the underwriting, we just said, hey, let's just sell all 30 units to an end buyer at the end of the day. And as we went through due diligence, we started working with the city and the municipalities to understand more, or rather various exit strategies. So we're at the point where we are working with an attorney group to condominiumize the individual assets, the individual homes on that cottage parcel, and sell those to individual homeowners, and doing that immediately as well.
Condo conversion.
Nice. So instead of selling those individual 6 units at a 6.5 cap in 10 years, we're going to go in and we're going to condominiumize it, spend even less money on the rehab, and sell it for an effective 2 cap, right? 2 cap, because it's going to be sold to a homeowner at a higher price.
Right.
So,
incredible.
Yeah.
That's a killer little deal you got there.
Yeah, and from what we're looking at, we're working with the lender on getting a recast and being able to pay off, up to about 40% of the loan within the first 12 to 18 months.
Nice.
Yeah.
So you're under contract on this. Are you through due diligence? Are you doing due diligence? Where are you with that?
So through due diligence, yes, and of course we did it fairly extensive. We had about a 30-day period where we went in, obviously inspectors, and phase one environmental study came back nice and clean, and yeah, I mean it was a full lease up review, property management, interviewing the legacy property managers and going through all of the work orders. That was one of the things that also was exciting about it, was going through the work orders. It was a brutal process, but through that process, we were able to identify where there were operating issues, which were either A, Band-Aid fixes, or B, actual root cause fixes. And the majority we were finding were Band-Aid fixes. And so, if you look at it from a cost perspective, our goal is to go in and do a root cause fix and alleviate ourselves of massive amount, probably $5,000 on a $25,000 or $30,000 operating repair and maintenance budget, with a very, very small amount of money going in relining a sewer line, something as simple as that.
There's a good little takeaway for listeners and for myself there. Review the work orders and as part of your due diligence when you're considering the deal. You can learn right where the rubber meets the road as far as your problems, problem areas or problem units or whatnot. So yeah, that's a good one. I like that one. Awesome. So, and then are you syndicating this thing? Are you raising capital? What are you doing?
Yep. So we are, I think, too shy short of $100,000 short of a $1.9 million raise on that.
Nice.
Yeah.
Real good.
We're stoked about that one, and moving right into a 506C on a 29 unit up in North Washington. That'll be a bit lower, but yeah, we're excited about it.
So on this raise that you just did, how did you do that? Where did your investors come from? I'm assuming that you've raised maybe a little bit in the past, but nothing like this, right?
Sure. Yeah. No, absolutely. You're absolutely right. So, raising capital kind of came organically at the front end of my career with flipping homes, and it was, inconsistent social media posts about flipping homes and things of that nature, and people reaching out, "Hey, love it. I always wanted to flip a home, but I don't have the time." And then conversations came from there of, "I don't have time, but I have money." And so, we worked on, I've worked with a couple individual investors on flipping one home at a time. And then, quickly realized that was the inflection point, by the way, of realizing that single family flipping was not for me, was when I had one investor per home, and I had more investors than I had projects at that point. Yeah. So I would end up turning down investors, which just didn't feel right. Yeah. Especially with the idea that at that point, again, we had less deals. This was back in 2020. Kind of 2020 timeframe, when residential homes were just going for $200,000 over asking, or 10-20% over asking. Yeah. So the inflection point was more investors than projects, and started with single families. First project was a syndication on a townhome development site. Raised about $700,000 there. Nice. Another townhome development site raised about $800,000 there. And then another smaller project raised about $150,000-$200,000 at some point last year. So, yeah, I mean, absolutely. Between those three, going from let's call it $800,000 at the high end to a $1.9 million raise was, a pretty big feat for us. and a little bit daunting, but
Yeah.
it played well from a timing perspective of one of the projects liquidated at the right at the juncture, right as we were going into the due diligence on these 30 units. So, it was always conversations, and I would say to listeners, to operators, is communication is absolutely key.
Yeah.
We love communicating with both our active and inactive and prospective investors. And, right now our way of doing that is monthly newsletters that we are very rigid on delivering as much information as possible in a very quick, concise way.
Yeah.
And that involves pipeline updates. Where are we at from a due diligence on the pipeline, or are we in a pre-due diligence deal, et cetera?
Yeah.
So,
how did you nurture and develop your investor base, the people that have invested with you?
Sure. So, obviously I shouldn't say obviously. The beginning syndication started off with 506B, so just family, friends within my own network, and a lot of those are personal friends, family, obviously, and really just checking in with them, especially the ones that really truly became active and proponents and true supporters of us, is really starting to dive deeper into them, as opposed to quickly just getting a couple investors and then spreading out and going to new ones. It was more so diving deeper into the current investors and making sure that I have true supporters out of each one of those investors.
Yeah.
Before again going off and going to a new conference, or just trying to hand out as many business cards as possible. It was trying to really gain the true support of a few, and then letting it kind of grow organically from there.
Yeah. So lots of word of mouth, referral type stuff.
Yeah.
Just had another guest on the show. We were talking about Shannon Robnett is his name, and we were talking about that there's really nothing more powerful than a referral. And as far as raising capital goes, like, they're not only willing to put their own money up and risk that, but they're willing to recommend it to you. It just says so much. It speaks so highly of you and your ability to keep the communication great and perform, right? Yeah. Execute on your business plan. Good stuff. So, the 29 unit coming up in the pipe. You're under contract on that one. Cool. What stage are you in the process with that one?
We are now going to lenders next week and starting to get term sheets and really truly be honed in on the final underwriting, getting in, doing the inspections, and so we're about 1 week into the 3-week, or rather 4-week due diligence period.
Okay, gotcha. When will you start raising for that?
That's a great question. Likely within week 3, between week 3 and week 5 is when we'll really start hitting the ground hard from a raise perspective. Right now, it's conversational.
Yeah. Okay. Very cool. And then, what's next? What's like, where do you want to, like, if you could wave a magic wand and after this 29 unit deal have an ideal scenario show up for you, what would that look like?
Sure. So what I want to try and avoid is the quagmire of the, do I have enough funds for payroll? Do I not have enough funds for a payroll on an individual asset? So the 60 to 90 basis unit apartment complex, and really trying to avoid that. So whether it's stacking the cards and obtaining, another, let's call it 30 to 50 unit apartment complex, or even, going beyond that and just getting into the low 100 unit apartment complex. So let's call it the 100 to 125. I think there's a jump between those two, right? The 30 to 50, and then why even dabble in the 50 to 90 or 50 to 100 and just go straight for the 100 to 125. again, I think the concern there is just the work or the asset needing payroll support, but maybe not necessarily having the operating budget to account or to allow for it.
Right.
So I would say if I had a magic wand, what's next? It's in 2023, obtaining, buying, acquiring a 100 to 125 unit apartment complex.
Okay. Nice. Are you goal oriented? Do you have goals in the space that you work towards?
Yeah, absolutely. I can't imagine somebody being successful without goals.
Yeah, I know but occasionally you do meet people that just kind of keep their nose down and do what they do at a high level. And
sure.
And I think I've also talked to people that are maybe 20, 30 years into their career, and they're like, oh, I'm just going to keep doing what I'm doing, But yeah, do you mind sharing with us what your goals look like?
Sure. And so from a company perspective, where we want to be it's a range from a time perspective solely because of fluctuations in markets. So from 7 to 10 years, we want to be at a $2.5 billion AUM company, all focused in the multifamily space.
Yeah.
We want to be national. We want to truly be national. Specifically, I would say the Northwest, the Southeast as being two of the two primary markets that we want to be focused in. So $2.5 billion assets under management, Northwest, Southeast regions. Want to have a $100 million property management company and a $100 million general construction services company as well.
Yeah.
Where again, we're all vertically aligned in providing services to the management company itself.
Yeah.
That we believe that we can get in the 5 to 7 year time frame. Those two services or those two companies itself. And from an immediate standpoint, we know that we need to be in the $100 million asset under management range within the next, I would say, 1, probably 2 years at most, with a team of around 5 to 10. So again, ranging it solely for the fact that we're going into a kind of a fluctuating market perspective, and so we know that we're going to have to flex, be lean on resources, be lean on internal staffing at some points, and then ramping up in order to hit some of the growth requirements as well. Yeah. But I would say underlying under all of that, really truly having a culture where we have a company culture that really is focused on a couple things. Primarily, in my opinion, growth. And growth can look like a multitude of things. Growth in terms of business, growth in terms of personal growth, is really, in my opinion, my number one focus is making sure that we're all focused on growing ourselves as individuals, growing the business, growing our community impact as well.
Yeah, I love that you mentioned the personal growth aspect of this, because entrepreneurship in general, to me, is an opportunity to invent this highest and best version of yourself.
Yeah.
And I've done a number of different things on an entrepreneurial level, and I've never found anything that I have so much love for as this space and this endeavor that we're all doing together, really. And the opportunity to sharpen the saw through all the things you mentioned, books, podcasts.
Yep.
I'll add national conferences, masterminds, coaching, all of the research, audiobooks, and even things like therapy. Like if you're working at different levels of your being, your soul, your spirit, whatever that is, if you're working at those different levels and you're healing core stuff, that is going to show up in your business all day, every day. You're going to operate with more ease. You're going to have more clarity. You're going to have more conviction. You're going to have more passion, and you're going to have access to this new version of yourself. So, little plug there for personal development and mindset work. I think, I personally believe that mindset's 80% of the game.
Oh yeah.
Yeah, at least
it's gotta be. I mean, taking care of ourselves from a physical, emotional, I forget the pyramid and the naming conventional, but physical, mental, emotional, spiritual, etc. It's absolutely critical to get to the very peak of who we are as individuals, because I do not, and I'm sure many other people don't want to associate their identity with the business that they run. It's so easy to, but it's just another piece of who we are as individuals. And running a successful company is part of me. It is not who I am, but it's the combination of that and my goals from climbing volcanoes, for instance. I want to climb Mount Denali here in the next 3 years.
Very cool.
Yeah. Very cool. And then getting to, personal weight and body fat percentages is another goal. And then actual reading books on an annual and monthly basis is another goal. And so all the combination or the simulation of all of that is who we are as individuals. So, and then you mentioned therapy. I mean, I think therapy is such an important thing for individuals, couples, etc. Where there are deficiencies, maybe not the best word to use there, but
I like constraints. I think that's a good word for that. Yeah.
Where you just need a little extra help or a little extra plug there, and to bridge a gap. And so I think looking at all of that in terms of who we are as an individual is critical to supporting the other pieces of ourselves. So not just diving 100% into the business self, because then everything else is going to start to deteriorate, and maybe over the short term your business might not be impacted. But this is not, in my opinion, not a short-term or short-term business. This is a long-term business. So taking care of ourselves is equally as important, if not more important, than, just staying only focused on running a business.
Yeah. Well said. It's like it's kind of like the holistic approach. And, amongst other things, you need to do this stuff to stay competitive. Like, because other people are doing it, other people are exercising, meditating, eating well, taking care of their sleep, that's who you're up against. So if you kind of look, I think there's a lot of crossover between athletics, sports, and commercial real estate, and entrepreneurship in general. And you got to be in good shape, tip top shape to compete out there. And that's all really good stuff. Carl, do you have a big why that drives you? I hardly ever ask this question, but for some reason I want to ask you.
Sure. That is a good question. So I would say it's twofold. Ultimately, it's always community, right? And so it all boils down to community. And that community could be familial, or it could be unknown community. So a community that I don't necessarily have a direct personal contact interaction with.
Yeah.
But it all boils down to community. So familial, obviously is kind of the underlying initial reason why. Being able to provide instantaneously for my family, having a comfortable life was the initial why. And then that quickly became, I want to be able to have take care of my child after I'm gone in an easy way. And then that quickly became where it is now. I want to have generational wealth. I want to have generational assets that effectively truly never leave the business, or rather never leave the family. And those assets protect, or those assets provide a certain level of value, or let's call it value, a certain level of value to the inheritance below me into perpetuity. And those could look like anything. I mean, where it could start, obviously skyscrapers, it could start with any mid-rises, it could start with anything. But, that's where the familial side of things is truly having generational assets that cover certain value aspects of my inheritance. And then secondarily is the kind of community unknown impact, meaning again, people that I don't know, but that the things, the services, the goods that we provide impact those individuals. And I grew up in what I would call a comfortable house, but by no means was it lavish. I would call it affordable housing. My father put us through college, didn't have any student loans, but certainly we never lived, again, a lavish life. And that goes back to the familial side, but the affordable housing, the people that actually owned and operated those, they did it for a reason, whether, for government tax reasons or whatever, it can't necessarily directly say, but,
right.
I think the ability to provide somebody with such a basic need as affordable, comfortable, and safe, reliable housing and safe.
Yeah. Totally.
Safe housing does so much to somebody's mental space, mental health, that so many people forget about it. And, my family was able to be supported in that way. And, I would love to be able to turn around and be able to provide that to other people, just as much.
Yeah. I love your the first thing you said was community and your effect on community that maybe you don't know, like you don't directly touch. We have 595 units in our portfolio right now, between 7 different communities. And it's totally not lost on us that the well-being of 595 families is really largely in our hands as far as our ability to provide, like you said, safe, clean, aesthetically appealing, bright, housing to people that are working hard in life and are hopefully good people. But
sure.
That aspect of community, I was actually a resident assistant in the dorms when I was in college, and so I was the mean rule enforcer,
law and order.
Yeah. But we talked so much about community and community development in that role, because it shapes people, and when people are part of a thriving, vibrant community, that wears off on them, and it's hugely influential.
Right.
And again, back to personal development, like people grow in those situations, like when there's vibrancy. So I love that, Karl. I think that's a tremendous value, core value to have. Yeah. Good job. Awesome, man. One last question. Well, I may ask you one after this, but what bottlenecks are you facing right now, if any, in terms of growth?
Sure. So on this last acquisition, the 30 unit, obviously one of the big bottlenecks was available capital. We were doing it as a 506B, so really non-marketed friends and family. So, that was truly, at least felt like a bottleneck to us. Just available capital, tapping existing investors and being able to grow bigger with a relatively tapped network. It kept coming up that we had more people that we had within our network that were interested in investing. And then, even still, so many of those individuals were not at this time ready to invest, but now they're primed, now they're ready, now the conversation has started. So, our suspicion is that this next acquisition raise is going to go by even faster. It should we decide to go 506B, but I think going the 506C route is going to help us open up that bottleneck to a certain degree.
Yeah,
and I think that. Let's check back in about 6 months and see how that works. But I think right now it's been the available capital, the available investors. And so I think tweaking the business model is going to allow that that bottleneck to open.
Yeah.
But then, of course, what happens next is the bottleneck shows. So after this, it'll be deal flow.
Yeah.
And after deal flow, it'll be operations. And then soon the flywheel will continue to go, and then it'll start again at capital.
Yeah.
So,
yeah, I got it. And I can identify with all of that from our experience at Greenlight. And, just to reiterate the importance of capital raising, like it's probably the most valuable activity that there is in this space is whatever you're doing to raise capital. So, so you want to get really good at that and have all the tools in your belt that you can possibly have. Karl, I would actually, you said, let's get together in 6 months. I would actually love to have you back on the show in 6 to 12 months and catch up with you on the 30 unit, on the 29 unit, and then talk about, what you're doing to scale up from there.
Yeah.
You'll probably have some other stuff in the pipe at that point. And these to me are like mini masterminds almost.
Right.
And I think that a listener listening in on a conversation like this, hopefully it's extremely valuable to them, because in a lot of cases, our listeners maybe haven't done their first commercial deal, or they've done a small commercial deal and are scaling up, or they're in single family looking to get in. And, this was the last, better part of an hour or so was really just a jam session between two multifamily apartment investors. And this is where the ideas flow. This is where value gets added. And so, dude, I'm super grateful for you to come on the show. Any other, not any other, but any kind of final thoughts for the listener as far as, getting that first deal done maybe, or kind of scaling into the space?
Yeah, I'm glad that you teed those two up, because that's exactly where I was going to go. Was, when I looked at the beginning of this year, we had 13 or 14, somewhere around there, units under construction. And I was just looking at, what does it look like to buy a multifamily? What does it look like to buy a 5+ unit, operating asset, operating value add? And there was no way I had in my mind that I was going to be closing on in operating 59 units, or 59 units across two assets by the end of the year. So even when I say I'd love to get a 100 to 125 unit apartment complex next year, I as much as daunting as that sounds, I know that it's certainly by no means out of the question.
Right.
And is most likely even smaller than what we can actually do. Yeah. So to the investors, to the people that are listening, if you're still listening, is you can do a lot more than what you think you can. And even if you set those big lofty goals, if you truly have the infrastructure, if you have the team in place, then you can do even more.
Yeah. Yeah. And really the biggest bottleneck is capital. And so when you say, you feel like you can do that 100 to 125 unit, I'm sure you can, just based on the success you've had so far in scaling into raising bigger amounts of capital. So I'm sure you can. I really, like I told you at the outset of the episode, I really believe you can get to your goals. And now that we've shared an hour together, I really believe you can get to your goals. Right. Like I think, Karl, you've got a great future ahead of you, and I, however we can contribute would be more than happy to help you succeed any way we can.
Love it. Well, we appreciate you.
Yeah. So Karl Krauskopf, how do listeners reach you if they want to learn more, or maybe just kind of, brainstorm a little bit with you, that sort of thing? How can they reach you?
Sure. So I would say two positions. So Auroras Investment Group.com. Auroras is with an S, it's plural. We're also on Instagram at Auroras Investment Group. And you can also reach out to me on either Facebook or LinkedIn. My email is karl@aurorasinvestmentgroup.com. And I'm always happy to have a conversation, whether it's with the newest newbie or whether it's the seasoned executive. So I'm happy to always have those conversations, help where I can. Love it.
Appreciate that. On behalf of my listeners, I appreciate that offer. And so, well, dude, this has been great. Thank you so much for taking the time and sharing your story and sharing the story of your business and where not only what you've done, but what you're doing now and where you're headed. It's really exciting, Karl. So
appreciate it.
So yeah, appreciate you being on the show. Listeners, thank you. We love you guys. We really appreciate you tuning in. We're doing 2 shows a week right now, really trying to provide as much value for you guys as we can. I'm not sure exactly why I'm doing 2 shows a week, but it's a lot of fun. I'll say that because I get to talk to some amazing people and I feel very blessed for that. So listeners, thank you. If you feel so led, please leave a rating and review on Apple Podcasts or wherever you're listening. That helps us out a lot. And we will see you on the next episode, everybody. Take care.
This has been The Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of The Apartment Gurus.